Hi, this is Carolyn. This is the second video of chapter 3. So in this video, I'm going to show you a small demonstration of how accounting process is performed. So the first thing I want to reinforce is that we are discussing a couple of different concepts in this chapter. We first have something called the journal entries, which we keep a journal. And in the journal, we keep each transaction using an entry. So a journal entry is an entry that keeps track of each transaction that happened to the firm. And then from a journal to a ledger, the difference is that in the journal we record the transactions separately, but in the ledger we summarize them. So we basically sort different accounts with the amounts associated with the accounts to the ledger, so that we have a summarized information of the transactions. We have another technique called trial balance, which is helping us to find out whether we made a mistake during the process. And finally, we have financial statements that summarize and reporting all the information to outside investors, creditors, and so on and so forth. Okay, so let's first look at the chart of accounts. A chart of account is is the chart that's showing us, again, it's a map showing us what kind of accounts we have and what are the numbers associated with the accounts. In this chapter, we have a couple of transactions, which we have basically seen all of them except the last one. So I'm going to demonstrate the first two and the last one in a way of what we have just introduced. First of all, we make an entry and then record that in a journal. And then we will post them. Remember, we talked about posting. We'll post them to a ledger, and then we'll use the trial balance to show we did it correctly, and then we'll do the financial statements. The first transaction is on October the 3rd. First of all, I want to set up, this is the basic setup. We have the transactions that are written in the blue fonts. And I have a journal, which is sort of like a simplified one. I have a journal basically showing each transaction. Of course, for the sake of time, I already write down the entries. This is your ledger, okay? Remember, we use T accounts to serve as the purpose as the ledger. So each ledger, each one is associated with an account and the amount the account that has. So I highlighted some of the numbers. Those are the beginning balance of each account. So which is from September. September the 30th, we close everything. We summarize everything. We find out that, for example, cash has $9,120 in it. This account has $9,120 in it. What does that mean? That means you have $9,120 of cash to spend in the future as of the date of September the 30th. So which September 30th would be October the 1st. So last month's ending balance will be this month's beginning balance. So the yellow, all the things that highlighted in the yellow color is the beginning balance of that particular account. So on October the 3rd, the client service in September pays the company $1,300 he owes. What that means, we serve a client in September, which we already recorded as debit accounts receivable credit revenue, right? So we already record the revenues at that time. Now when the client pays us back, obviously cash increases with the debit, so we debit cash. Accounts receivable decreases because he pays us what he owes. So our accounts receivable decreases. Accounts receivable is the asset account, decreases with the credit side. So we need to debit $1,300 in increase in cash. I set a formula, so automatically my accounts receivable credit $1,300. Okay. The second transaction is on October the 6th, the company buys the $400 supplies, agreeing to pay for them later in October or November. So when we buy supplies, supplies increase, obviously, right? So I'm debiting supplies because it's an asset account, increases with a debit side. Because I didn't pay for it, so I cannot credit cash. What I'm crediting is the amount that we owe someone else. That is the liability. Liability increases with the credit side. So I'm crediting the liability, which names accounts payable. So I'm debiting supplies 400. I'm crediting accounts payable 400 from here. Okay. So that's how I get the journal entries. I have a solution tab here showing all the entries that I have. Okay, now this is my journal. So my journal is like your diary. It keeps record of what happened during the day, during the month, and so on and so forth. So you can do all the rest of the transactions by yourself or by reading the textbook. I'm just going to talk about the last one on October 31st, the manager's review of supplies showing that 525 of supplies are on hand. What does that mean? Okay, how are we going to record that? I'm going to skip just going to directly to the solution and show you how we do what we are doing here. Okay, so if we look at the supplies account, the beginning balance, we begin with the 575 supplies on hand, which means last month we have $575 of supplies left on hand in our warehouse, whatever. In the month, we said we bought some supplies, $400, right? So that's what we bought, we purchased, so it's on the debit side. Now you can look at each transaction afterwards. It didn't talk about supplies anywhere afterwards. We didn't record any change of supplies except for October 6th transaction. Now, if you look at the last one, it says the manager review of supplies showing that 525 supplies are on hand. This means that if I add up what I have originally and what I bought, I have $975 of supplies. But when I'm reviewing my supplies at the end of the month, it shows only 525. What does that mean? That means I used some of them, right? But I didn't record. This is one way that companies may record their inventories or supplies or so on and so forth because it's too trivial. So we are not recording each time we are using a pen because it's too small. What we do is that we add up all the supplies we bought and then we count how much we have left at the end. We can derive how much we have been used. Okay, so let's say you have 575 pens in the beginning. At the beginning, you bought 400 other pens during the month. Let's say this is $1 one pen. Okay, so this is you have 975 pens to be used. But at the end of the day, you count your drawer, you find only 525 pens. What does that mean? That means you use up 450 pens. Okay, you don't want to record every pen you're using, so otherwise you are recording 450 transactions of them. So some of the transactions they're too trivial, so we will use this way to derive. So what we would do is that obviously supplies decreases, right? Because we use them for 450. What is the debit side? Because we use the supplies to generate revenue, right? That means it's an expenses. So any resources that's used to generate revenues for our firm is called expenses. So this is helping our manager. For example, you're teaching a guitar lesson, you need the strings, you need the pens, you need a whiteboard eraser, so on and so forth. Those are all supplies. And when you're using them, they are supplies expense. Okay, so we are debiting the expense because we increase the resources that used to provide our service, but we decrease the asset that's called the supply. Okay, so that's how we do the last one. All right, so after you keep the journal like this, you have the full set of, this is like a full set of book of, page or book of the transactions your firm has been experienced during the month, right? But if I ask you how much cash do you have right now? It's very confusing. You cannot tell me exactly how much cash do you have left. That's why we want to have this, which is a summarized information of each separate account. Now you can see what I mean by sorting. We are sorting all these information to you can view this as a pool of the transactions. We are sorting it to different bins or different silos because they are different categories. Okay, so that technique is called posting. So now let's post the entries we have made. So this is 450, I just said. Okay, so let's post what have been done. What have been done is that the first one, we debit cash 1300. I'm going to debit my cash account 1300. This is my ledger, okay? And then I credit accounts receivable 1300. I credit accounts receivable 1300. Okay, that's what happened. I debit supplies 400. So I go to the supply account journal. The supplies T account, which means it's the supplies general ledger. I debit that general ledger for 400 for the second one, and then I go to accounts payable. I credit that for 400. Okay, so we have a lot more cash transactions, so I'm not going to summarize cash, but this is the only accounts receivable, I think. Yeah, this is the only accounts receivable transactions that we have experienced during the month. So I'm going to summarize this account. The debit side, we have 1300, credit side 1300, so they cancel out. Remember, it's an asset account, so normal balance should be on the debit side. So I'm going to write 0 on the debit side. This is just a convention. Supplies, right? Supplies, originally we have 575, and then we add 400 to it. At the end of the day, we use up 450, so we credit 450. Now, what is the ending balance? So supplies would start with 557 plus 400 minus the credit side, right? Anything on the credit side, we have to minus it. So that's 525. It's exactly what it means. The manager reviewed the supplies, showing 525 supplies on hand. Okay, so that is the idea. You can review the solution section to just find out all the transactions and the numbers. Finally, we have something called trial balance to help us to detect whether we have done something incorrectly. In case, for example, if I have a cash 1300, when I'm posting it, I'm posting 1200 to it, right? Then I'm crediting another 1300 and have a debit equal to my credit. So I have something called the trial balance showing each account, their numbers, and their balances. But we separate any accounts with the debit balance, we would put them in one column. Every account with credit balance we put in another column. So you will see that, for example, for cash 10 to 80, I'll put that in here, cash 10 to 80. Okay, the function of trial balance, if you summarize each column, they should be the same. Okay, now let's say if I did something incorrectly, if let's say as I said, I did this 13,000, but when I post it wrong as 12,000. What would happen? It would be 10, 18, 100, 110, 180. That means when I'm adding these two columns up, it's not the same. Then I know I had made a mistake somewhere. I'm going back to check where I have been making a mistake. Okay, so that's how we detect where we did things wrong. Now there's something that you cannot detect. For example, if you completely miss a transaction, there is a transaction that you forget to make an entry of it, or there is a entry but you post it twice, or you didn't even post it. So any symmetric error to this trial balance, the trial balance wouldn't detect them. So it would detect some unbalanced errors, but it wouldn't detect those balanced errors.